Tirthankar Patnaik, Director and Strategist with Religare Capital Markets joins us. Tirthankar, good morning and thank you for joining us. Tirthankar, it's turning out to be a stable month of trade. There are no big, trending moves. However, the underlying bias is still positive. What are your thoughts?
No, I totally agree. I mean, underlying bias is positive. Of course, we've been always saying that do not expect the market to go about it monotonically. We expect the markets to go up roughly, at least, trail earnings over the next 12 months now. About 15% growth is that what we are looking at on the index, but it's not going to be monotonic given the state of the macro, given that global situation is volatile at some point. So, it's not going to be a straight move. But yes, the underlying situation remains positive. We've seen some pain come out in July. We've seen the market take some profits, some money off the table in July, but August has been somewhat okay until now.
Are you a bit surprised with the institutional appetite for some of these richly priced stocks, irrespective of the valuations and the earnings trajectory for some of the pharma, IT, auto names? The institutional appetite for some of these quality names is insatiable. What is going on with some of these names?
Well, there is some part of a rotation also happening, away from beta that we had seen, which was around or until the election number. So until that point, you were basically playing stocks that were beaten down, sectors that were beaten down, essentially domestic cyclicals, and there was a good money to be made there. But post that, you realize that the macro recovery is fairly long round. It's going to be taking another 4 to 5 quarters at least. Inflation numbers are still not in control. So from that perspective, you want to be positioned in India, but you also are looking for earnings visibility. And sectors like IT, pharma do give you that particular feature. Sun, Lupin, or in the IT space, Infi, TCS, all of these stocks are large cap stocks, which, yes, I agree with you, are richly priced. That point is very well taken, but they do give you that earnings visibility. So a good quality based portfolio is what has worked for you over a longish period also. So that is essentially why institutional appetite, it is positive for India. At the same time, it realizes that domestic cyclicals are not going to give you that particular fillip at the moment.
Tirthankar, you've liked ONGC for a while now. The diesel price hike is most likely to continue this month too. More importantly, there seems like there is going to be a clear decision now on the ONGC FPO and the gas price hike as well. Is ONGC the big ticket win that one should bet on right now?
Even now, we remain positive on ONGC. Our analyst maintains that you're looking at about 15 to 20% upside on the stock even now over a 12-month period, and that coming for a large cap stock like this definitely makes it a price part of our model portfolio. We have been positive on the energy space for a while, and as you pointed out rightly, the events in terms of gas pricing, in terms of diesel getting practically market driven, and the next phase in terms of LPG and SKO becoming market driven, although that might take a little bit of a time, are features that the market will price in and will not basically finish with in a month or so, or even in a quarter. So we see ONGC re-rating upwards, and 15 to 20% upside is clearly within the stock's reach.
Tirthankar, the ring of a new high, it's always a nice ring, but for the moment it looks like it's a routine ring.
Well, we expect, like I said, 15% upside for the market. So, work out that for Nifty. So we are looking at in a year, we are looking at a 9,000 plus Nifty. And we maintain that we are reaching 8,000 by the end of the year. It's going to probably happen in this expiry itself. So, if the market does move up from here, there is upside surprise. Sure.
Your Nifty target is 8,000 for the end of the year, and Nifty is almost at 8,000. So do you think now Nifty or markets are richly priced, fairly priced? Because they've already breached your target and earnings are not that strong that you would like to increase your target. So is it time to sell now?
Well, no. So which is what I was trying to say, that valuations are at around long-term averages right now, roughly around 15.8, 15.9 times. Valuations can overshoot from this point, but we are not saying that the markets are expensive. If the market reaches around 17 odd times, which is around 10% higher than the long-term average, then one has to really take in a call that yes, are we firmly in control of inflation? Are we firmly in looking at a 6.5% number for FY16, which is what the consensus is working out? then one could take a call if the market is richly valued. At this point, not really. There are pockets which are expensive, but clearly the market has upside. So like I said, we are looking at a 9,000 plus Nifty buy in the next 12 months. So this is the underlying bias is positive.
Tirthankar, what's looking stretched to you at this point, considering you're giving just a 50-point upside for the whole year for the Nifty? Any spaces that are now looking overheated?
No, so like I said, I mean the 50-point upside is does have a reasonable upswing to it. We can look at the markets going up further. Just that if you want to reach about 1,200 more points over the next year, it is possible that we'll reach it earlier rather than it could be front-ended also, this kind of price. But to answer your question in terms of which sectors are getting stretched, yes, large cap cement has done very well this year, and that is why our analysts have steadily professed now moving to the mid cap side of the sector, trying to play the in shrinking valuation differential between mid cap cement and large cap cement. Yeah, so large cap cement is where valuations could seem a little bit stretched. One could probably take some money off the table there because the bet has worked very well. Consumption also, most consumption stocks are trading at north of 25 times earnings, which is where also you might see some kind of correction going forward.
Tirthankar, you mentioned that it is now time to revisit mid and small cap stocks, and some would argue that does it make sense to actually buy into mid and small cap stocks because they may look cheap, they may have not participated, but they are not growing. Bulk of the earning growth, bulk of the earning visibility still lies with large cap companies, be it IT, be it pharma, be it large cap engineering companies. So why go the mid cap way when the path is unknown?
I'm not professing going for the small and mid cap space en masse. I was merely saying that in the cement space there are mid cap stocks which have stocks like Orient Cements, stocks like Birla, stocks like Ramco, stocks like Sanghi Cement that our analysts recently visited, and we've written about it. So those are stocks that are doing fairly well. Mid caps en masse are not likely to do well right now. We've seen the pop at the beginning of the year. The next leg for mid caps is likely to be with earnings upgrades. So one has to be fairly specific here. There are mid cap stocks that we like, but not really the universe in mid caps right now.
Tirthankar, are you liking any of these spaces, defense and, more importantly, FDI now getting into spaces, rail, for example? Does it make sense to put your money into any of these defense names?
I gotta ask, the FDI defense was okayed earlier. DIPP comes up with a view that, yes, FIIs can also buy into, defense names now. So the market took up many of the stocks, BEL also to 20% up levels. My read is that going forward, there is upside for these stocks, but this is not where the big money is going to be made. This is not, from a macro perspective, this is not where you're looking at significant levels of capital. Most defense companies, when they come into India, would demand a majority kind of stake. And then secondly, technology transfers is not something that's going to happen fairly quickly. So yes, these are flavor of the season, and short-term money could be made there, but not a long-term, not a long-term call here really.
So besides the spaces, Tirthankar, which we've discussed, where is long-term opportunity in this market, which is, sort of already 50-60% at least of the up move is already done?
Well, if you ask me, there are spaces where our model portfolio strategy remains the same as we had over the last couple of months, which is we're playing domestic cyclicals, we're playing it through energy and cement, and we are negative consumption, and we're neutral on IT and financials. In financials, we remain positive on private banks. So stocks like ICICI Bank, stocks like Axis Bank, HDFC Bank remains our top pick at this point. So, and amongst the PSU pack, we like SBI. So that's been our stance. That's likely to remain. In large cap IT, we believe Infi has a fairly large upside even going forward from now. So that essentially is our, and we are neutral on metals. ONGC, I already pointed out, is our overweight play. In the mid cap space, we are far more picky. We are looking at stocks in the pharma space. We are looking at stocks in the finance space, in the consumption space. So we have stocks like Indoco Remedies. We like stocks like Glenmark, Aurobindo. All have done fairly well, but we see meaningful upside even going forward. If you ask in the consumption space, we like Britannia, we like Dabur. These are stocks, and Bata has been our favorite. So those are plays that are doing well. In the energy space, Gulf Oil is one stock that we have liked. In the agri space, we like Finolex. So we have been fairly picky across sectors, and we believe that wherever there are good companies that have good earnings, good return on capital, like in the speaking of capital goods, Compton Reeves, Cummins, these are stocks that we like. So we have been picky, and we would maintain our preference for mid caps, but very selectively.
Is the underlying thesis in buying Crompton Greaves, because the fortunes of Crompton Greaves are completely correlated to the power sector, and all of us know that the power sector is currently in a dire state?
The long term is what you need to see here. Good money has already been made. Take a breather right now. Look at it from a 12 to 24 month perspective, and you're looking at about 30 to 40% hike on Crompton Greaves from now.
And you said that you like Bata and Dabur, and Bata and Dabur are good companies, but are valuations on your side? Do you think it makes sense to be a buyer now, or one should wait for a meaningful cut? When I say meaningful cut, 10-15% cut at least before somebody allocates capital to Dabur or Bata.
You may not get that 10 to 15% meaningful cut is what my worry is. So, we would maintain our overweight positioning at this point. We're not saying take money off the table, maintain the overweight position. Of course, if you are lucky, you get a 10 to 15% cut, great. But that shouldn't be the driver really. For a large cap, for a stock like this, where you have meaningful upside over the next 2 to 3 years, 10 to 15% is what you will make up anyway, despite, buying the stock at these levels.
Oroma Container Corporation, and it's with that railway theme, 1380 rupees for Crompton Greaves, not for Container Corp, it is not far away from a 52-week high. Tirthankar, if you have to, let's say, make a portfolio which could be called as a high risk, high return portfolio, and which could have a shelf life of about 12 months to 18 months, what would you like to buy in that high risk, high return portfolio? Someone who's ready to, let's say, bet on a 10% downside or 15% volatility, but is searching for absolute high return ideas or multi-bagger ideas.
So, it need not be high risk even if it's high return. So, my point is Indoco Remedies will be one stock, Gulf Oil would be another stock. And in the finance space, Bajaj Auto Finance is where we like. Then Britannia, again, not a high risk, high return, but high return actually. So these are stocks that we would like from that perspective. In the mid-cap cement space, as I pointed out, Orient Cement, Birla, these are stocks that we would put in such a portfolio.
119 rupees at least for the moment for Orient Cement. Okay, Tirthankar, I'm going to change the scope of our conversation completely, and I'm going to throw in one more element in the melting pot, which is the global cues. And for the longest time, at least in this year or in last 6 months, we've not seen a sizable correction in global markets. Global volatility is at an historic high. Global markets are riding on strong doses of liquidity. But in the next 3 months, at max 6 months, Fed will move. Fed is likely to increase interest rates. What happens then?
Well, yes, your guess is as good as mine there. The S&P is on a one-way trip. The dichotomy between US equity markets and US debt markets has never been more stark. US debt markets are telling you that growth is likely to remain a prolonged story, whereas S&P is basically telling you that you might see a 3% number next year. You might see rates coming up quite sooner than expected, as you yourself pointed out. In terms of rates, this is probably the first time in last 4 to 5 years that central banks globally are not working in consonance. You'll probably see the Bank of Japan pumping in more liquidity. They will probably take it to about 70% on their initial balance sheet levels when they started with Abenomics. ECB will probably start doing actual quantitative easing rather than doing what it takes. They will actually start buying in the bonds. Basically, European peripheral yields are telling you that you will probably see bond buying coming in. On the other hand, you will probably see Bank of England and the Fed basically raising rates maybe sooner than expected, given that inflation numbers are at already 2% for the nearing 2% at core for the last 3 months, and food inflation is fairly high. So yes, global situation is a little bit tricky here, and from a behavioral perspective, US markets have not seen a significant correction for the last almost 2.5 years now. yes, global situation could see a risk off. That could have an impact on our markets as well. Yes. Our view, however, is that, barring a very sharp correction, and we don't believe a very sharp correction will happen right now because growth is picking up in the US. It's not shown a meaningfully negative surprise. We saw how the first quarter was bad, but second quarter we saw kind of a rise. 4% growth is what we saw. We should not, if we can rule out a very sharp correction, then overall flows levels should be positive for India. Debt has already seen about $16 billion come in. Equity has seen about more than $12 billion come in. So things look positive on the capital flow side. And given that this is a macro turnaround story, you're going to see flows go on further. So the worries that you pointed out earlier on in the program about India that we had a year back in terms of its twin deficit, lack of political direction, have all been fairly taken care of. Fiscal deficit is under control. Current account deficit is likely to be under control for the next year as well. Rupee is fairly stable. Growth is turning around. Inflation is where we will probably reach the first milestone of 8% by January. We'll probably reach 6% by the next year also. Although that's a little bit questionable here. We might see a re-rating for India if the credit rating agencies are, turn benevolent all of a sudden. So things should be positive for India from a global perspective. And I might add that crude remains fairly benign at this point. I would not believe that crude will remain at near 100 levels. Probably 105 to 108 level is where crude will stabilize. You do have overshooting on both sides. So at the moment, however, what's important is that diesel under recoveries are very, very low. Diesel will go to market price. So for
Right. Tirthankar, good chatting with you. Really appreciate you taking the time out and speaking with us.